Welcome to the deep dive. Today we're doing something a little different, something tailored for, I think, the really experienced and critical investor out there. We're tackling a fascinating piece of research on a company that, it often flies just under the radar. Coca-Cola Bottling Co. Consolidated, ticker Coke. And to be clear, this is not about the global brand, not the capital light marketing machine that is the Coca-Cola Company or KO. No, we are diving headfirst into the gritty, capital-intensive world of their largest independent U.S. bottler.
And what makes this mission critical right now is, frankly, the sheer audacity of Coke's recent strategic move. The big investment question we have to answer isn't about stability anymore. It's really about capital allocation conviction. We need to figure out, is this company's, impressive financial outperformance, the margin expansion, the stellar returns, is that the result of a durable and impenetrable economic moat? Or is it just a temporary blip from that big refranchising effort between 2013 and 2017? For a discerning investor, that's the whole ballgame. It determines if this is a compounder or a value trap.
And that's where the story just fundamentally changes. The key event, the one that defines everything now, is that seminal transaction back in November 2025. Coke engineered a repurchase of all 18.8 million shares that KO held for $2.4 billion. This wasn't just some routine buyback. This was, for all intents and purposes, a leveraged buyout of their own independence. It took them from being sort of a subsidiary-like entity to a fully independent operator, but, and this is the key, one with a brand new, significantly leveraged balance sheet.
Precisely. That transaction is a profound, immediate shift in the company's risk profile and, maybe even more importantly, its governance. What management has done here is declare, through action, their absolute confidence in future free cash flow generation. So much confidence that they put their pristine balance sheet right on the line. So our mission today is to really dissect that thesis. Do their local logistics advantages, their operational excellence, do they provide a wide enough moat to justify this new leverage? Spiking the net debt to EBITDA ratio to 2.6x, that's a big move. We need to analyze that moat, validate the profitability shift, and really stress test the capital discipline they'll need.
Okay, let's unpack that moat thesis first because it's completely counterintuitive for a lot of people. The report says Coke has a wide and durable economic moat. Now, most people hear that and they immediately think, oh, the Coca-Cola brand.
Yeah.
But that brand power, that equity, it belongs to KO, right, the franchisor. So where does Coke, the bottler, the distributor, actually get its power from?
Right, and that's the critical distinction. The power doesn't come from the brand. It comes from tangible, physical, logistical dominance. We define it as local economies of scale. This is a concept, popularized by people like Bruce Greenwald, that says competitive advantages in these heavy industries are almost always local, not global. Coke is a manufacturing and logistics business. It's a high fixed cost, capital intensive model, the polar opposite of KO's asset light approach.
So we shouldn't be thinking about the national beverage market. The real battleground is these specific bounded territories, Charlotte, Nashville, Cincinnati. How does being the biggest player in that specific local footprint give them an advantage that, say, a smaller competitor just can't touch?
It creates an insurmountable fixed cost advantage. That is the very definition of a scale moat. Think about all the costs. The specialized warehouses, the huge fleet of trucks, the sales force, the automation. Those costs are largely fixed within a given territory. And because Coke is what the report calls the elephant, they often control over 40% of the non-alcoholic ready-to-drink value in their territories. They get to spread those enormous fixed costs over a much, much higher volume of cases than any rival.
Let's put some numbers on that. So if Coke has 40% market share and needs, say, 100 trucks and 10 warehouses in a city, what does the competitor with 10% share need?
They need pretty much the same infrastructure, maybe marginally smaller. They might only be running 30 trucks, but they still need warehouses. They still need a sales force to cover the exact same geography. But the key insight is the unit cost absorption. Coke is absorbing its fixed costs over 4 times the volume. That creates a massive structural cost per case advantage that flows directly to the operating margin. We'll get to that in a bit.
And that leads to the critical metric in this whole business, drop density. How do they maximize the value of every single time a truck stops?
Drop density, or sales per stop, is really the beating heart of their cost advantage. When a Coke truck pulls up to a store, it's not just delivering Coke and Sprite, it's delivering this huge diversified portfolio. You've got high-growth stuff like Monster Energy, Reign, Body Armor, Gold Peak Tea, Smart Water, and then through cross-licensing, they've got the Dr. Pepper brands too.
So because they have this whole portfolio of must-stock items, A single stop for them generates way more revenue than a stop for a rival who only has a few brands.
Exactly. That superior revenue per stop directly lowers their cost per case delivered, and that becomes the ultimate barrier to entry. An entrant just can't replicate that route density without burning cash for years. And even if they wanted to, the franchise rights prevent them from even getting their hands on the core products, like Coke itself, that you need to build that scale. The moat is deep because the entrance fee is astronomical.
Okay, let's talk about the legal wall that protects this whole operational moat. The Comprehensive Beverage Agreement, or the CBA, with KO. This contract sounds like it's the bedrock of their stability. What are the key provisions in there?
The CBA is absolutely the legal fortress. The most critical part is that it grants them perpetual franchise rights in their territories. I mean, technically it's structured in 10-year terms, but they're indefinitely renewable unless there's some kind of material breach. That perpetual nature is everything. It lets them confidently invest hundreds of millions in long-lived assets, automated production lines, robotics, knowing those assets will generate returns for decades.
And beyond just the security, the CBA actually helps them by, eliminating competition from within the brand?
Yes, exactly. It's a subtle but profound advantage. The CBA gives Coke the exclusive right to make and distribute all KO brands in its territory. So KO can't compete with them directly, and no other bottler can sell Coke products in their footprint. Retailers, the customers, they have to deal with Coke, period. It completely removes any negotiating leverage a retailer might have from pitting distributors against each other. Coke controls that last mile.
But there's this tension, right? KO wants to sell more concentrate and drive volume, while Coke wants to optimize price and margin. How does KO not just squeeze them into oblivion?
It's a classic case of mutual dependency. KO needs Coke's hyper-efficient distribution network to actually monetize its brand equity. If KO jacked up concentrate prices too much, Coke's profits would suffer, and they couldn't make those critical capex investments of $300 to $370 million a year. An inefficient Coke network directly hurts KO's sales volume, so that mutual need keeps things in a structurally balanced, if sometimes tense, relationship.
Okay, so the moat is durable. But a moat around a shrinking pond isn't that useful. How has Coke adapted its product mix to deal with the secular decline in sugary sodas?
That's the essential risk mitigation piece. They have successfully transitioned from just being a soda distributor to a total beverage partner. The sparkling CSDs, that's the cash flow ballast. The volume is flat to slightly down, but it's incredibly stable. The future, though, the resilience, that lies squarely in their still beverages segment.
So what's in that still category that gives you confidence they can pivot?
It's designed to capture all the big consumer shifts. First, you have energy. Distributing Monster and Reign is huge. It's high growth and high revenue per case, which feeds right back into that drop density metric. Second is premium hydration, smart water, vitamin water, Topo Chico. And third, and this is increasingly important, is functional nutrition. Things like core power and body armor, which command premium prices. The Q3 2025 data really proves it out. The still category had net sales growth of 9.9%. That confirms they can capture value even as the soda business faces those headwinds. And that leads us right into the financials. This next section really validates everything we just talked about. The data from 2020 to 2025, it's not just an improvement, it's a structural step change in profitability. And this was deliberately engineered by management's pivot to a new mantra: value over volume.
That pivot is so important for a quality-focused investor. They call it revenue growth management, RGM. But this is more than just raising prices, isn't it?
Oh, absolutely. The sophistication of their RGM is what sets them apart. It's about using data, AI pricing tools to optimize shelf space. It's surgical. It's about mix management, pushing consumers toward the high price per ounce packages, like the 20-ounce single serves and the mini cans. Those have way better margins. And at the same time, they're de-emphasizing the lower margin stuff like 2-liter bottles. That strategic shift is what drove the 6.9% net sales growth in Q3 2025.
The big stress test for that pricing power had to be the inflation spike in 22 and 23. What did that period show us?
It was definitive proof of the moat. They aggressively passed through rising costs, aluminum, sugar, everything, and the results were stark. In 2023, net sales grew 7.3%, even while physical case volume actually declined by 1.9%. That divergence, where value growth just crushes the volume decline, is textbook evidence of inelastic demand. Consumers in their territories absorb the higher prices. It validates the whole theory.
And this structural reset should show up dramatically in the margins. I mean, when we look at the operating margin growth, is this just a cyclical thing, or is this a fundamentally different business?
It is a fundamentally different and structurally higher quality business. You have to remember, Before all this, their margins were in the low single digits, sometimes flirting with zero. But now, look at the expansion. Gross margin went from around 33.6% in 2018 to almost 40% in 2024. That's a massive 6-point expansion. And the operating margin, this is the real validation of the local moat. It shot up from a razor-thin 1.25% in 2018 to 13.3% in 2024.
Wait, a jump from 1.25% to 13.3%? That's
Good.
enormous.
Hmm.
That tells you that the synergies from integrating all those new territories plus the RGM pivot, it's finally letting them leverage all those fixed costs. That 13.3% margin is the proof of the drop density theory we were talking about.
Exactly. The theory is validated by the operating leverage. But we do have to introduce a counterpoint here, a threat. Even in Q3 2025, their SD&A expenses, selling, delivery, and administrative, they rose 6.6%, and management was explicit. It was driven by labor costs related to annual wage adjustments.
So it highlights this perpetual race they're in. They have pricing power with the customer, but they're super sensitive to wage inflation in their DSD network.
That's the Achilles heel. If wage growth keeps running at, say, 4-5%, and the revenue growth from RGM settles around 3-4%, those hard-won margins are going to contract. It's a constant battle.
Okay, let's pivot to the ultimate proxy for quality, especially for a capital-intensive business. Return on invested capital, ROIC, how do they stack up?
Their ROIC figures are, frankly, world-class for an industrial company. It surged from 14% in 2020 to a peak of almost 25% in 2024, and it settled at a still commanding 20.3% on a trailing 12-month basis.
Walk us through that. For a critical investor, how much higher does that ROIC need to be than their cost of capital to be considered world-class?
The spread is everything. We'd estimate their WACC, their weighted average cost of capital, is probably around 6.3% conservatively. So with the 20.3% ROIC, they're generating returns that exceed their cost of capital by nearly 1,400 basis points. For a company that relies on trucks and bottling plants, that is exceptional. It validates the entire refranchising strategy. It shows that every dollar they put back into the business generates truly outsized returns.
Speaking of returns, before we get to the debt, let's touch on cash flow. Their cash from operations is often way higher than their GAAP net income. Why is it important here?
It's crucial for understanding the power of their deleveraging engine. So year-to-date 2025, they generated $723 million in cash from operations, but only reported $433 million in net income. That big gap comes from the high non-cash charges, specifically depreciation.
So all those trucks and warehouses create a big depreciation shield on their taxable income, meaning they hold on to a lot more cash than the P&L suggests.
Exactly. And that superior operating cash flow is the true powerful source of liquidity that allows them to so rapidly execute the deleveraging plan we're about to discuss. The FCF engine is much stronger than GAAP implies.
All right, let's get to it. We're moving from operational efficiency to capital structure. That November 2025 transaction, you called it a buyout of independence, but it was a massive leveraged financial maneuver.
The scale and intent were definitely aggressive. On November 7th, they bought back all 18.8 million shares KO held. That was something like over 20% of the entire public float, just taken out in one shot.
And a $2.4 billion deal like that needs some pretty sophisticated financing. How do they pull it off?
They used a mix of cash on hand and a $1.2 billion bridge loan. But they moved fast to get long-term stability. By December, they had already refinanced that bridge loan. They issued new senior unsecured term loans, split between 3-year and 5-year tranches, totaling $1.35 billion. A very smart move to mitigate short-term risk.
So from an investor's point of view, the immediate benefit is just a massive boost to EPS, right?
Yes, the share retirement is expected to be significantly accretive to EPS starting in 2026. Now, of course, the new debt adds a lot of interest expense. That's a headwind. But the reduction in the share count denominator is so profound that the net effect is a sharp, immediate turbocharge to EPS.
But beyond the math, the strategic win of getting KO off the board and out of the stock, that removes that old principal-agent conflict.
That might be the most significant long-term value driver. Historically, KO had a board seat and could push its own volume goals, selling more concentrate, over the bottler's goal of maximizing margin. With KO gone, management is now solely accountable to public shareholders. The focus is laser-sharp on profitability.
And it's an undeniable signal of management's own conviction.
A profound signal. They torched their pristine balance sheet to do this buyback because they had absolute internal conviction that the stock was a bargain at $127 a share. They're staking the company's health on their future FCF.
Okay, but 2.6x net debt to EBITDA.
Mhm.
That's a huge jump from being almost debt-free. For a capital-intensive business, isn't that flirting with disaster if a recession hits?
That is the exact question the market is wrestling with. The shift is radical. Pre-transaction, they were under 0.5x. Post-transaction, it spikes to 2.6x. Now, it's manageable for a stable business like this, but it completely changes the risk calculus. It leaves very little room for error.
And the credit rating agencies noticed immediately.
They did. S&P Global Ratings quickly revised their outlook to negative. They kept the BBB plus rating, but that negative outlook is a clear signal that 2.6x is above their comfort threshold of 2.0x. It forces management's hand.
So the roadmap for the next 2 years is simple. This is a deleveraging story. It's balance sheet engineering.
Precisely. Management has explicitly committed to a rapid deleveraging plan. They're targeting getting closer to 2.0x by 2027 to avoid that downgrade. And the engine for that is the robust free cash flow we talked about, somewhere between $450 to $500 million a year.
And that commitment means a freeze on everything else, right? What have they done to make sure cash goes to debt?
The actions were decisive. The board slashed the remaining buyback authorization down to a symbolic $400 million. They've signaled a halt to any significant M&A or special dividends until 2027. All that FCF is going to pay down that $1.35 billion debt. For an investor, it means returns are driven by a simple, powerful transfer of enterprise value. As debt shrinks, that value shifts back to the equity holders. Which brings us to valuation. How should the market value this newly leveraged but highly efficient company? We have to look at it relative to its peers and focus on that trade-off between quality and leverage.
Okay, let's start with the standard multiples. How does Coke stack up against, say, Coca-Cola Euro-Pacific Partners, or CCD, and Keurig Dr. Pepper, KDP?
It generally trades at a premium, which reflects its U.S. stability and that operational superiority. Its forward PE is around 19.6x, which is pretty comparable to CCE. On an EV to EBITDA basis, Coke is in the 10.8x to 12.5x range, which puts it a bit above an emerging market bottler like KOF, but similar to a domestic peer like KDP.
So why does it command that premium valuation over a peer like KOF?
It's justified by efficiency. Pure and simple. You measure that with ROIC. We said Coke's ROIC is best in class at 20.3%. KOF is closer to 11.6%. KDP is around 6.5%. The market is paying a premium multiple for Coke because it is structurally better at extracting returns from its capital. That efficiency gap justifies the higher valuation.
Let's talk about the dividend yield, because for a lot of investors, that's a big deal. Coke is a low-yield stock.
And that contrast is really important. Coke's yield is minimal, like 0.6%. Compare that to CCEP at 3% or KOF at over 4%. It's an explicit signal from management. Coke is a capital appreciation vehicle, not an income stock. They retain that cash flow to reinvest in the business and, for now, to pay down debt. It's a compounding play.
And just to put the leverage in context, 2.6x is high for Coke historically, but how does it look in the industry?
It's manageable in that context. KDP is running around 3.0x leverage. CCEP is even a bit higher at 3.5x. The market gives Coke the benefit of the doubt because it's a stable U.S. consumer staples business. The debt level itself isn't crazy, but the speed of the increase means that deleveraging plan has to be executed flawlessly.
Okay, so moving past the deleveraging, where does future growth come from?
It is heavily, heavily weighted toward that still segment. It's all about winning market share in specific subcategories.
The research really highlights their dominance in energy.
Right, distributing Monster and Reign is transformative because it feeds right back into the moat theory. Energy drinks are high growth, high revenue per case. It improves drop density, it improves revenue per stop. At the same time, they're tapping into functional nutrition with core power and body armor. That stuff commands premium prices. This premium portfolio provides the growth to offset any CSD headwinds.
And they're not just relying on product. They're spending that $370 million a year in CapEx on technology, too.
A huge chunk of that is going into supply chain automation. We're talking AI and machine learning for dynamic routing and predictive ordering. The goal is to reduce the cost to serve by optimizing routes in real time. Every tiny fraction they shave off distribution costs goes straight to the bottom line. And it just raises the technology barrier to entry for smaller guys even higher.
And then, assuming they hit that 2.0x leverage target by 2027, what about M&A?
Post-2027, we fully expect them to get back to being the primary consolidator of the fragmented U.S. bottling map. There are still smaller, family-owned bottlers out there with territories right next to theirs. Coke can go in, apply its superior operating model, and extract synergies immediately. M&A is a huge long-term value creator for them once the balance sheet is prepared.
All right, a critical investor needs to vet the downside. That November 2025 deal introduced a whole new level of financial risk. Let's start with that 2.6x leverage spike. What are the immediate threats?
The leverage trap is the most tangible risk. That 2.6x net debt to EBITDA doesn't leave much of a cushion. If their cash flow engine sputters because of a recession or faster volume decline, that deleveraging timeline is threatened, and a downgrade becomes very real.
And the primary threat there is the exposure to floating interest rates.
Precisely. Those new term loans are based on SOFR, so they're variable. That's a double risk. First, if the Fed keeps rates higher for longer, interest expense just goes up. Second, if they get a credit downgrade, the spread they pay over SOFR will increase. That higher debt cost could completely offset the EPS benefit from the buyback, negating the whole point of the transaction.
So we have to watch the debt covenants. Which one is the most critical guardrail on management right now?
The one to watch is the fixed charge coverage ratio. It has to stay above 1.5x. This is what stops them from distributing cash through dividends or buybacks if earnings start to falter. It forces them to prioritize debt service. If they breach that, they lose all capital allocation flexibility.
Let's move to the existential threat hanging over the whole industry. The GLP-1 Ozempic effect. This isn't cyclical, it's secular.
This is the elephant in the soda aisle. The anecdotal evidence that these weight loss drugs curb cravings for sugary drinks is very strong. It poses a fundamental threat to that CSD cash flow ballast.
So if sparkling volume declines accelerate from, say, -1% to a more alarming -5%, does the investment thesis still hold?
It only holds if the growth in the still segment accelerates even faster to compensate. It becomes a battle between two curves. If CSDs drop 5%, the still segment would need to maintain or even accelerate its 9–10% growth just to keep overall value flat. Coke is better hedged than most, but it's a risk that requires constant monitoring. And then there are the operational risks. That DSD model is very reliant on people. Labor relations are a constant threat.
We've seen strikes at competitors. What happens to Coke if there's a work stoppage?
It would instantly cripple their network. Unlike a manufacturer, Coke relies on rapid, consistent delivery to keep its shelf space and uphold its contracts. A strike would cause immediate and severe disruption. And even without a strike, we've seen labor inflation is a relentless pressure on their margins.
Finally, even with a legal moat, they still face massive concentration risk from the power buyers, the big retailers.
This is where the CBA moat ends. They are beholden to giants like Walmart and Kroger. We saw it in 2024. Walmart decided to change how it distributed Dasani water, moving away from the DSD model for certain packages. That single decision by one customer negatively impacted Coke's reported volume by 1.3%. It just shows you how much power the retailers have to influence their growth at any time. So if we pull this all together, what you have in Coca-Cola Consolidated is a very unusual, very high-quality industrial company. It's generating world-class returns, that 20% plus ROIC, rooted in an operational moat that's protected by both local scale and legal contracts. That combination is exceptionally rare.
And that 2025 buyback was the watershed moment. It was financially aggressive, yes, but strategically essential. It removed KO's influence and perfectly aligned management with shareholders, maximized margin and free cash flow.
So the whole investment case really hinges on their ability to execute this deleveraging plan flawlessly. The wide moat, the proven profitability reset, and the future EPS accretion from the buyback. Those are powerful tailwinds that I believe ultimately outweigh the temporary risk of the higher leverage. This is a business built to compound.
So the verdict for you, the experienced investor, we'd classify Coke as a strategic accumulate. This is basically a high-quality toll road for America's most popular drinks. It offers a clear path to compounding equity value that's driven by internal discipline, not just market growth.
And our final provocative thought for you to consider is all about capital discipline and the quality of their earnings. That big divergence between their cash from operations, $723 million year to date, and their net income, $433 million, that's the key to the whole story. So given the heavy, constant capex this business requires, you have to keep asking yourself this question. Does management's current discipline focus on using that superior cash flow to rapidly pay down debt provide a better, less volatile return path for shareholders than if they were forced to chase unprofitable volume or just issue higher dividends? This 2-year deleveraging story is arguably a masterclass in capital discipline, betting that superior cash flow against a temporary debt spike to maximize long-term equity compounding.